With today's ETF Edge and the growing debate over buffer funds, as investors decide if downside protection is worth limiting possible gains. Dom Chu, following the money force domino.
All right, so Judge, what happens if you don't have to have a cap on that upside? So as the markets grind higher, those so-called buffer ETFs have been catching a lot of flack for that limited upside potential. But there's a twist in the methodology that some ETFs have to kind of quell out some of that criticism. Joining me now is Mike Lucas, the CEO of TrueShares ETFs. We're going to talk about a little about this idea that we have uncapped buffer ETFs. That means you actually get more of the upside with limiting the downside. How exactly do these funds work, mechanically speaking?
Well, back in 2020, we pioneered the uncapped buffered ETF because of one simple belief, and that was that capturing as much of those chunky right tail events is just as important as mitigating those left tail or downside events when it comes to long-term compounded returns. So mechanically speaking, what we've done is, because as we all know, there's no free lunch in hedging, but what we've done is we've used a traditional buffer and we've set an upside capture or a participation rate to the upside with no limit. And so when you see, I'll take the first year we were out there, for example, our first product launched in July of 2020. The S&P was up about 39% in the succeeding 12 months, and we returned close to 31% from a buffered product when most of our peers were capped out in the teens. And so that's an example of how you can still maintain the growth characteristics of equities to the upside when you have a buffer in place.
And Mike, just how often in the history of you running these funds have you actually been tested with regard to that downside versus upside potential?
Well, I think the reality is that if you look back 30 years and 12-month rolling returns, roughly a third of the time, call it 34% of the time or so, the S&P will return north of 17%. And the average return in those time periods is about 26, or a little north of 26%. So every few years, roughly a third of the time, you're going to have a chunky up year that helps buffer or at least pad your performance throughout the life cycle. But if you look at a series like Liberation Day, for example, right? Let's look to last April. I think that was the biggest test for the buffered space to date, barring the pandemic, which I think was in the early days of the buffered space. And we learned a lot of things about buffered products in that time frame and now in the succeeding snapback.
All right. Mike Lucas, thank you very much. We're going to continue this conversation over at etfedge.cnbc.com. Mike's going to be joined by Tony Kelly, the co-founder of Bond Blocks, for a fixed income conversation along with Buffers Scott. So tune in, 1 o'clock Eastern time. I'll send things back over to you.
All right, Domino. Thank you.